guess who finally made the live? It is yours. Well, his truly, Ryan Weeks from Escape to Arizona.
Good to see you guys. Thanks for having me, Lizy. I appreciate it.
Yeah, we're super stoked. Sorry we're late. Ryan got to see me troubleshoot a loan issue for more than 30 minutes. But fun times.
It happens for sure. Yeah.
It does happen. So for those of you who are new to buying a home, I just want you to know that buying a house is actually considered the second most stressful short-term event in a person's life, with death of a family member being number one, okay? So lots of deadlines, lots of emotions, and sometimes it just happens where people are just like very stressed out, and they have to talk to you, otherwise they can't sleep. They're calling you like 4 times in a row. Like you just got to handle it. So I appreciate you guys hanging in there for me. We got lots of really great questions in the chat. I cannot wait to answer. But first and foremost, I do want you to introduce yourself to my peeps.
So, yeah, thank you once again for having me. So I have a YouTube channel as well, so it's called Escape to Arizona. Basically what I do, I've been doing it since COVID hit because, we had to kind of shift and pivot. I used to sit open houses all the time. And it's just something that's always been in the back of my mind. So what I do is I go out and do a lot of like neighborhood tours. I do model tours. I pretty much talk about anything that I can think of. Like today I put out a video on the direction of the home, how that's important in making a decision on what to purchase. Yeah, it's just little things like that. So that's kind of what I do, and just whatever comes to mind and whatever questions my clients have, I usually put a video out and, just try to create some content. And then you get sucked into the YouTube world and, start making crazy other videos. And then you're like, should I start another channel? What should I do? Like, you just get really sucked into it. But yeah, that's what I do. And of course, real estate and helping people buy. So love it.
So, fun story, Ryan and I were internet friends. So meaning that I'd only communicated via email, via YouTube, yes, and then the phone up until 30 minutes ago.
Right.
So this is going to be super fun. I can tell you, though, he is a super hardworking real estate agent, and I've been very impressed with his hustle.
Thank you. Thank you.
All right. So let's give you an update on what's going on with mortgages. So if you are currently trying to lock in your loan, it must feel like emotional whiplash. Rates have been relatively flat, and when I mean that, it's just like we've had, up to 20 basis point movement in the market for good or bad, like literally throughout the day for the last 3 days in a row. Last Wednesday, we had a huge increase in interest rates because of the Fed meetings, the Fed minutes, there we go, God, and the Powell press conference. And so what ends up happening the week after a Fed meeting is that we get all the commentary from all the, other mini Feds from all the different states and people's opinions on what's going to happen with monetary policy. And that can really swing the market, especially mortgage-backed securities. And so that's what we're feeling. It's very common. It happens every single time. But if you are somebody who is trying to time the market, this is going to be one of those times where any headline will move it. So I would lock in. This is the type of market where I have a locking bias. But again, you'll have to talk to your own loan officer. They know your scenario, they know your situation, and you have to ask whether or not they are following market trends, how often they're staying ahead of it. If they can't answer 1 to 2 follow-up questions, probably not the right person, especially if you're trying to time the market. What are your thoughts on rates?
I think they're going to go up definitely. And yeah, we're seeing just a lot of volatility, like you said. So I definitely agree with you, Lizy. Lock in and just, instead of trying to speculate, just get in and get a house,
Yeah,
so.
I'm not really a fan of rolling the dice.
Yeah.
So Ryan works for 72 Sold, and it is a really interesting real estate concept in the Valley. So essentially, and let me know if I'm butchering this.
No,
I'm
go
trying
for
to
it.
learn the sales
Yeah.
pitch. So essentially, they create a ton of buyer demand through these launch parties. So they market a property, get a bunch of interest, and only inconvenience a seller one time through these launch parties. They bring everyone in, try to get the highest and best offer, and they've been super successful at selling properties in 72 hours or less.
Yeah,
Hence their name.
That's basically it.
So I really love trailblazers like this because whenever something disrupts the market, we always get way more options for our consumers. Is there anything I missed on that?
No, I just like going further with that. I think now they have such a reputation in just creating this buyer demand, and that's actually why I joined with them, because I just joined with them like 2 months ago. And you know that when you're going into a 72 sold listing with a buyer, that there's just going to be a ton of demand, a ton of offers going way over what they have it listed for. So I think now they're getting the reputation to where they can actually see some offers before they even launch and accept those offers. So it's pretty cool. It's definitely a strategic program that's been working for sure.
Yeah, and I heard you guys have like double-digit market share in terms of like inventory.
8%, I believe, is what we hit. I don't know if we've gone up to 10% in terms of.
8% is super huge, guys.
Yeah,
so like when you think that there are 10,000 listings
nuts.
that they would have 8% of that is a huge number. So anyway, I just kind of put that out there because, since you're here and anyone's looking for a real estate agent, he might be your man. Okay, so first question is from Sam Weller. He says, "Hey Liz, by the way, I never go by Liz, so I'm going to let this slide just this one time." Says, "I started my LLC, going to pay myself with a 1099. I have 2 bank accounts, one for business, one for personal. What are the requirements to get approved for a loan to buy a house?" So it's really difficult when you're just starting a business to qualify for a house. Home loans are based around stability and consistency, especially as it relates to income and payment history, okay? And so when you start a new business, it's hard for us to know whether or not the income that you are receiving is going to be stable and what the expenses are going to be for you to generate that kind of income. So generally speaking, the rule is 2 years of self-employment, right? 2 years worth of tax returns that reflect self-employment. But you can get away with 1 year so long as you have experience in the line of work at the same or higher income level than you're receiving. So like you just have to be able to show consistency, right, and stability in that format. And so those are the basic requirements. I don't know when you started your business, but it sounds like you've set a good foundation. Now, one thing you might also consider is what it would look like instead of paying yourself via 1099, paying yourself W-2. That might be another way for you to talk with your tax accountant, right, to help make it a little bit easier to qualify down the road. And no, you can't just use the W-2 to income. It's just like 1099 income is typically used for like a Schedule C. And so I think that there's some like tax questions that you need to be talking to your accountant on.
Yeah, W-2, you'll definitely pay a little bit less tax, I believe, up to a certain point. So definitely W-2, that's what I do personally. And yeah, for the 1099, I'd say have another account for taxes almost, because you don't want to get hit at the end with a big,
So
big
Ryan
tax bill.
says this because he's a real estate agent, and in his so I went to this conference once, this marketing conference that had nothing to do with real estate. It was just literally marketing in general, and they had a CPA on the stage, and somebody asked what's the industry where you see the most crazy tax situations or people are the most disorganized? And no joke, 3 seconds in, they're like, realtors.
Yeah, I can see it.
Okay, so we got Rod and Laura here from Michigan. Super awesome to see you. We got Jen. We have Paul Ernest, Juan Carlos, Andrea, Julie Rocky. Okay, so Paul says, with the increased volatility in the stock market, does that push more people to rush in to list homes because they think, even if not true, a housing crash is on the horizon?
I don't think that they're rushing to list homes. I mean, right now there's a shortage. It is being picked up pretty quickly, but yeah, I don't think that they're wanting to just sell. And I don't. Most of my clients, I mean, they don't think that a housing crash is coming. So it's. That's been a controversy for the past 2 years. And I keep seeing these videos on it, but I've yet to see it. So I think there's low supply, still a good amount of demand. And that's what I try to educate both my buyers and my sellers on, for sure. So
people treat real estate and stocks very differently. But one of the like fundamental things you have to learn about any kind of investment is that you do not make a panic decision. And so oftentimes whenever the market moves or swings, you see tons of people freaking out, cashing out so that they keep like whatever money they have left. And that kind of thinking actually is what causes the domino effect of people losing even more money. And so you really just want to be a like super strong emotional person when it comes to any kind of investment. But generally speaking, people will sell stocks more like rapidly than people will sell real estate, because real estate, one, either involves where you live, right? And so that security is very difficult to change, or it requires a renter, and like up leveling a renter is harder to do. So no, I don't see tons of people rushing into the market. And also I will say that while that has been a topic that's been very controversial, and yeah, you still got YouTubers making dumb videos.
It's a lot of views, that's for sure. If you just
kind of, but I mean, I feel like it's so burnt out. I do think people are getting over that concept. And guys, if you're waiting for the next like housing crash, just know that my personal thoughts is that's when like we see a large percentage of boomers die, or 30 years from now when millennials' children are supposed to buy. Right? Like Elon Musk had a recent thing about like the population, like how we're not populating the earth enough. So anyway,
I didn't see that. I didn't see it.
Yeah, I'm always looking at like what's going to cause large increases in like housing. I also Google silver tsunami, for all you tinfoil hat wearers. All right, so Juan Carlos says, hi, is it easier to get a pre-approved for a new construction loan than a conventional loan, or are those loans similar? Planning to buy later this year and would like to look at multiple options. So couple of distinctions. New construction, unless you're talking about a construction loan, typically will allow you to finance conventional and will allow you to finance FHA, VA, jumbo, depends on the price. So they're all fairly the same as buying like a resale home in general, although they do take longer times and have more contingencies on when you have to have a loan approval, when you order the appraisal, things like that. There's slight differences in the nuance of the process, but generally speaking, they're the same to finance. A construction loan, though, like if you were going to build your house from scratch, is a lot more complicated and definitely harder to qualify, because you have to find a contractor that's willing to, use a construction loan. You have to get multiple bids. You have to get the right type of lender. That type of lending is scarce. I don't personally do it. And typically I believe they have like higher interest rates and larger down payments, although don't quote me because don't originate those. So that I hope answers your question. I want to follow up the question though to Ryan. Do you think it's easier to get a home buyer under contract on a new build or a resale?
I would say, as of right now, a new build, but there are really long wait lists, so that's been kind of the problem, wait lists. Some do have availability, but what I've noticed with the homes that are available is that there's something about them, and like I'll get constant emails about these homes, and there's just something about either the location or like it'll have a little yard and it'll be priced at $600,000 at 2,000 square feet, so they're just nobody's buying some of these homes, believe it or not. But I would say it depends. Resale, you can definitely get in and get a house, but new construction's kind of more the sure way to go, but you're going to be dealing with price increases as well. So I think, if it was me personally, I'd probably take the dive into resale and then just kind of have new construction as a backup. So,
okay.
Hope I answered that. I don't know.
Well, one thing that I want you guys to consider, so he's talking about like the level of competition for homes, is that this is the type of market where you really have to have multiple strategies and be really flexible. Yeah. So a wait list is complicated for some builders, and some of them do lotteries and so you really just have to be your own advocate when it comes to that as well, just because real estate agents, while they're very informed and they do lots of work, right, a lot of the cancellations, like they really go to the squeaky wheels that are calling all the time. So you just want to be prepared with that. And then with resale, like you want to do everything possible to make sure that your offer stands out. So getting fully pre-approved, meaning you provided all of your documents. It's within like the most recent 30 days. Some of these pre-qual forms are like still have 2% interest rates on them and they were from November. You know, you've got to make sure that they're super recent, and that you've stayed up to date, and that you're doing extra things like writing a letter, showing proof of funds, having your loan officers reach out and advocate for you. Those are going to be the things that keep you successful in a market like this. And I think that, honestly, it wouldn't hurt for you to do that on new builds and purchases.
Yeah,
resale.
definitely.
All right. So Andrea says, I purchased my home in Gilbert and we want to add a pool. My kids want the rock slide and waterfall. Heck
Sweet.
yeah. I'm concerned this feature might bring the value of my home down.
No, that's pretty cool. I mean, it's all about desirability. Who doesn't like a rock slide and a waterfall, for sure? I'm actually it's not a rock slide, but I'm getting a slide in my backyard. So I think it'll bring the value up a little bit. Are you going to get all your money back for that rock slide? Probably not. But if at the end of the day, if you're going to enjoy it and your family's going to enjoy it, then yeah, throw a rock slide in there for sure. And a waterfall. And a grotto. I don't know.
So here's the thing. So water features and pools and landscape, they're really expensive up front, and a lot of the value that you get is actually your personal use. So it's never a dollar for dollar like return on that type of investment to your house. So you just have to realize that like pools on an appraisal get anywhere between $5,000 to $20,000 at max in value, depending on the area. And so you want to consider, are there other houses in your neighborhood that have a pool to that level of upgrade, right? And so if your house is going to have literally the most decked out backyard, I don't know that you're going to see that return. Now, I don't think that a pool feature like that is going to, bring down the value, but I don't think you're going to get a dollar for dollar return. Other thing you want to consider too when it comes to upgrades on homes, guys, is that you always want to upgrade whatever is appropriate for the area. I recently had a situation where the house was literally the nicest house, could possibly be within like a 3-mile radius. It was so overly improved that the appraisal came in $130,000 low. And in this marketplace, I actually still think it's very difficult for someone to pay that much over what an area costs unless they can see that the house will eventually be worth the return within a year to 2 years. Whenever there's that large of a dependency, you're more than likely going to take a loss. And even in this market, because I've seen this now, houses will sit if they're overpriced or they're over improved and people aren't willing to pay the difference. Are you seeing that also?
Yeah, definitely. A lot of overpriced homes right now. And if something's over improved, I saw one in Queen Creek that had like 2 casitas, pool and everything, and trying to get a pretty outrageous number for it. I don't know what it eventually went under contract for, but there were a lot of price changes on it. So you're definitely seeing some things sit right now, and homes that are just way over improved for the area, or you're not going to get all that back.
Okay, so I have another follow-up question to that too, especially because you guys are doing all those launch parties. I see a variety of different strategies when it comes to listing people's homes. So some people, because the market is so aggressive right now, and they see that their neighbors are getting like $50,000 over asking price, they just want to start the list price out that high. And those are typically the ones that I'm seeing are sitting, when if they just listed it at value, they might create a bidding war. Are you also seeing that?
Yeah, with 72 sold, one of the things that we do is we list at what we think it would appraise for. So that's really going to bring the most buyers in. If you're listing it too high, then what's going to happen is you're eliminating those buyers, and what they're going to do is go look at a house that's actually listed a little bit lower that might be a little bit more improved. So really you do want to list the house at what we think it would appraise for. And we come in with a whole statistical sheet and everything, and give you some numbers and some examples of those when we're doing our listing appointment. But yeah, you don't want to price it too high. And on the flip side, you don't want to price it too low either, because it's just, you don't want to price it too low and not have it get to the number that our client wants it to get to. So Yeah.
It's always better to create that bidding war scenario so that you guys are getting, like, whenever there is competition, guys, people pay. All right. So Julie Rocky says, I'm looking to purchase a house around the same time next year to qualify for the PSLF and would need to consult. I'm not sure what that is, hon. I'm going to need you to elaborate. Will this hurt my credit score if I close accounts? So yes, whenever you consolidate debts or you consolidate student loans, just realize that you are restarting the time period for what a new credit account is. And typically you don't see positive benefit from a new credit account until it's been paid 6 to 12 months. The great rule is like 24 months of payment history. And so if you're having marginal, like if you have a marginal credit score or you're on the cusp of like if 10 points would drop you, would take you into different pricing bracket, I might leave everything the same. When it comes to credit consolidation, you have to be really careful. There is a ton of companies in the marketplace that say, oh, don't worry, we'll consolidate your bills. You'll make one low minimum payment. And what they do is they have you stop making all of your bill payments so your credit goes to shit. They then try to negotiate on your behalf for lower payments. And essentially it's like getting a bankruptcy, except you don't get the benefit of having them wipe out your crappy payments. And it takes so much longer to recover from that. So I would be very cautious with how you do it. Now, there are lots of zero interest credit cards that allow you to consolidate other accounts. If you can do that without closing the credit accounts, I might think that that might be a good choice, especially because you have a year to pay zero interest and hopefully, really, knock out some debt. But generally speaking, I probably wouldn't just go rogue on this. I would talk to a mortgage professional that can really advise you on the best steps.
Yeah. 0% credit card to 0% credit card. Just keep flipping it. Just keep putting it in.
Okay, so back in the olden days, guys, so my husband always makes fun of me because I always had the discount everything. So I had the Cricket phone, and then I had the Discover card. He's like, who has a Discover card? I'm like, I have a Discover card. And they had one of the best zero interest credit cards, and it actually did help me get out of debt. Seriously.
There you go.
And I did have to do the little 0% every year until I got out.
Right.
So it happens. Okay. Will loan officers within CCM family in my city of St. Paul, Minnesota refer me to realtors too? Oh my God, Julie. Yes. And I have world's best loan officer aside from me. Her name is Lisa Wells. She is incredible. You will love her. And she works with the best real estate agents, I promise you. She's Ritz-Carlton status on that. So if you message me afterwards, I will put you in contact with her. You will love her, love her, love her. All right. So Abe says, what are ways to pay off a mortgage early? Is adding extra principal payments or make it a 15? Okay. Sorry, guys. I need glasses. Sometimes it's hard for me to read these things and I literally, so also funny story. So my eyebrows are half gone because I got Botox for the first time today.
Hey, Botox.
My face looks so distressed all the time in the videos. I'm like, I got to take care of that. So where did I digress? What was I? So I can't read. But I understand your question, which is how do I pay my mortgage off quickly? So here's what I would do. I would contact your mortgage servicer and ask them for your amortization schedule, which tells you how much principal is going to each payment every single month. And then I would ask them to work out what it would do to accelerate your payoff if you made an extra principal payment every other month. So the rule of thumb is generally if you make one extra payment a year, you can knock off anywhere between 5 to 9 years of your mortgage. And so, but you really will want to pay, get to an amortization schedule and really hammer that out. But that's a really great way. There is a semi-controversial, as far as real estate goes, video on my website about velocity banking. It's the strategy where you either take a zero interest credit card or a line of credit, you charge all your expenses, so that way you can spend all of your paychecks paying off your credit and then adding way larger additional principal payments to your mortgage. And lots of people use that strategy and they pay off their mortgages in 5 to 7 years. I do think it's a risky strategy. I've never liked what is it, robbing Peter to pay Paul.
Right.
I think it's risky because you are literally like living off of a credit card, even though it's paid off every month. I don't know. I've never been a fan, but look into that as another concept, and you do your research. But start with a amortization schedule. Oh my goodness, guys! I think this is Kyle Cota from like my high school. So like, I'm gonna date myself. Well, I'm gonna date us both, Kyle. Sorry, but that was like more than 20 years ago. I'm like so pumped that you're on this live, and also kind of embarrassed because I'm still a dork. So there's that.
I just met her in person, so you know her better than me. I don't know.
So yes, I can help you in Tucson. And the market is still very aggressive down there too. It is like you have multiple things that are going on there. Like it is a very large retirement area and also a very large military area. So you have a lot of people moving in to Tucson. And so inventory is still very, low and limited there too. I work with a bunch of really great real estate agents down there, two of which you actually know personally. So, oh my God, so excited it's you. So I can talk to you offline about this, but I'd love to work with you. So there's that. Okay, so Devin says, hey Lizy, when you refi your property, part of title's job is to verify nothing crazy, like there is a lien on it or a quit claim deed right. Thanks for all you do. Oh, yes. So title's job, and correct me if I'm wrong, is one, to be the neutral third party between you and the bank and then you and the seller. And their job is to verify the ownership of the property, right? And so they're guaranteeing that to the bank because if anything were to pop up on title, hypothetically, it would take first lien position because it was on title prior to our loan. And so if those things happen, you take out an insurance policy to protect your and the bank's interest. The other thing that they do is that they verify how you want to take ownership, and that matters, guys, if something happens to you. So like if you were to get in a fatal car accident, like who do you want to have ownership of the property? So they do that too. And then in case of contracts, they're technically supposed to be a neutral third party between you and the seller. What's your take on that?
Well, in this market, the sellers are able to, work with the title company that they want. It seems like a little bit more. So we recommend, we can't tell a buyer which title company to use. So you do have the right to use whatever title company you want. So if there is a relationship there might be, some, headwind one way or another. So definitely as a buyer, try to work with the title company that you're comfortable with. So that's what I would say on that.
But there's a lot of people, okay, because you're an agent, and guys, just so you know, like literally my internet friend that came to do this live with me, why do agents advocate so hard to use their partners, like title and lending? Well,
some agents do have like an agreement with them where they get a little bit of a kickback, I believe. I don't have any agreements like that. I'm not that hardcore, but that may be one reason. But another reason might be just if you're selling a lot of homes, you like to keep it with one title company. And if you work with somebody, you have that relationship with them. So just like a lender, but it's just somebody that can get the job done and you have confidence in. There are some title agents that I don't have confidence in, and that I do try to.
And like, what are some issues? Like, why wouldn't you have confidence? Don't name names, okay?
Yeah.
So we're not like, we don't want to be sued here.
Yeah, exactly.
But like,
just getting the settlement statement not correct, not seeing addendums, losing items, things like that. So just those are some of the problems I've had. I haven't had any serious issues where there's been anything wrong with the title itself, but definitely you can with addendums and keeping track of things. It's kind of important because if you have a $5,000 credit that you're supposed to get as a buyer or a seller, you want to see that check at the end of the day. So, yeah.
Yeah, so getting paid is super huge. But here's why it matters. So I actually ended up having like an annoying title issue today. So we have been under escrow, which means under contract, for 45 days on this deal. That is a very long time in this marketplace. Yeah. Like our average closing is 21 days, just to give you guys reference. So we've had title. Now, when you get a title report, it tells you like, who's currently the payee, so the seller's mortgage company, who's on title, what liens are on title, and it gives you like requirements for insurance. Well, there's this one section 4, if it's not on our schedule A or B, which I normally check. And not that I missed this, I didn't understand this. There was this weird requirement to get attorney approval, like their legal department's approval. And so I don't use this title company very often. They're actually very small, like small presence. Like, I don't know. I didn't know that this would be uncommon. Turns out, okay, that my seller bought a foreclosure property during the CARES Act when everyone couldn't be evicted or foreclosed. And so it's hard because you have to have these affidavits that are signed that said, hey, there was no eviction and nothing was, done improperly. But the thing is, he's owned it literally since 2020 at this point, okay? So since 2020, the property is vacant. And oh, by the way, that should have been a freaking email. It should have been, hey guys, we have this huge problem. And that's why it's so important, because they didn't say anything. Our close of escrow was today. We literally find out about it today. And they're like, but it was on the title report. And I'm like, I'm so sorry. Like, this language right here, this thing that says that your legal department has to approve the title, like that was where I was supposed to find out that the owner of the property brought this during the CARES Act and it might have been an illegal foreclosure. Is like, that stuff does happen. Not to mention you get the wrong title people and they handle all the paperwork and you can't sign for several days, or you can't hear back for several days and you miss closings lots of time for that. Or let's say you cancel, right, and you have your earnest money in escrow with them and it takes them more than a week to return it to you, but you can't use the funds for your new purchase. Like, all kinds of crap happens. And so while I air quoted neutral is because we have our relationships, because we get consistent, great work from these people and we can trust them. Mm-hmm. And so because we're all humans, it's like, I don't think that anyone can be truly neutral, right? We can follow the law, which is what we should be doing. But I'm
always neutral, always. No, I'm just kidding.
You're kind of neutral. I mean, if we're gonna, like, you're more neutral than I am.
Yeah.
Like, I definitely have an opinion. I'm like, screw these people. But yeah, like, it bothers me. So yes, you do want to care who you're using for title, and I would get your realtor's recommendation because they've had the most experience working with them. And so now I'm gonna get the hell off my soapbox. So
there you go.
All right. So Scott says, hey, I'm curious, bouncing off what Abe asked, would you recommend paying off your mortgage early or putting the extra money into something that grows, like a mutual fund? I hate mutual funds. And this is my personal money. I am not a financial advisor. And I'm going to ask you your personal money thing, so get ready. But mutual funds, guys, rarely outperform the S&P 500, which is an index fund that you can buy. And generally speaking, come with 0.5% to 2.5% in fees, depending on who you go with. And over time, as you apply money in that, it compounds. And so I just, for me, I'm totally great paying like a premium for something that gives me a huge return. But a mutual fund is literally just an investment that was chosen by a hedge fund that your financial advisor put you in, and so you really have to be very aware. Now, investing the money, I think, is way more important. Your house appreciates, guys, at the same rate, regardless of how much you owe on it. And so because interest is still historically low and you can get returns on like actual investments, like, real estate's an actual investment, but like on investments that pay a higher return, like 8 or 9, maybe double-digit return, depending on how good you are at doing investments. I always recommend that because regardless of the time, the amount of interest you're paying, you're still getting more than a double return. So I hope that answers your question, Scott. I'm passionate about that too. But ultimately, if it's your forever home and you're really, you're going to be on a set income, paying down your mortgage definitely makes sense too.
Yeah, I'd say so. You could pay off your mortgage and then put that money somewhere else as well, buy a rental maybe, but with, rates as low as they are, borrowing money right now is, I think, a good idea. But you could always pay off your home too, so.
Julie Rocky, if you can elaborate for me what that PSLF loan is. Unfortunately, when you put that in here, I didn't realize you also emailed it to me. I don't know what it is, and I hate not being able to answer you. So, all right. So Mario Flores asks, Sorry, I took in too much air. I hope
No,
you
no
guys
worries.
couldn't hear that. Okay, I locked in my new home build for $340. It appraised at $380. There's a quick moving home, the same model and square footage as mine. It's under contract for $462. After it records, could I refinance my home and then would it appraise at a higher amount? This is a really good question. And honestly, this is probably the first time in my real estate experience where you can buy a new home build and walk into equity. Mm-hmm. Is this the same for you?
Yeah, it's been good for buyers. So yeah, been seeing situations like this happen quite a bit.
So I think this is one of the major benefits of buying new construction. Now, and sometimes it might outweigh the rising interest rate costs. You really just have to decide if the rising appreciation will negate the amount of extra payment that you're making. But so how it works is that generally speaking, you'll want to wait at minimum 6 months to refinance your home, especially if you're looking to pull cash out. So there are limitations on that, and there are some penalties to your loan originator who loaned you the money, right? So generally speaking, it's after 6 payments, which is 7 months after you got the loan. Now, if you are just wanting to refinance and there is no limitation based on your loan type, hypothetically you could do it you could start the process the day after you close. And so when you're looking at comps, and this is a realtor question too, generally speaking, you need more than just the one outlying comp in order to increase value that much, right? So if you have one comp that's closing for $462 and then another one that closed for $380, it's doubtful that that $462 is going to appraise because the last comp is the $380. Now, if that $462 isn't going to close for 12 months and they have other sales that can support that purchase price, over the next year, yeah, I would definitely look into refinancing once there's more sales in the market to be able to support the price.
I concur. You should be a realtor. What are you doing? Yeah, I mean, they'll take usually, 3 closings is what they're looking at for an appraisal. And yeah, I mean, if it just depends on what else is closed there. And with new build communities, you are seeing, you'll see a 462, but then you might see like a 390 close as well. And it's got to be within the same, usually within a mile radius for that.
So what happens? So I get this question a lot, where they're like, well, I just saw this house sell for $642 and my house should sell for $642, but then everything else hasn't sold. What do you do to try to explain that? Because hypothetically, those are the last sales, and I think it's hard for a consumer to understand why you wouldn't necessarily use just one sale.
So, wait, what's your question? So, if a house...
why wouldn't you base, the price of somebody's house off of a super high comp like that isn't necessarily supported in the neighborhood?
Well...
Oh, you guys! Javier Vidana, the king of YouTube, just gave us a super chat. Everyone, say thank you. Thank you,
Thank
Javier.
you, Javier.
It's actually our friend-iversary today. We had he sent me this. I honestly didn't even remember being at this event. He sent me this picture, those Facebook memories that come up from
those are great.
7 years ago. And I was like, dang. So it's passed by so fast. So anyway, happy friend-iversary, friend.
Wow. That's awesome. So yeah, back to the question. I don't, if someone's trying to sell, you're asking if someone's trying to sell at 462.
As a listing agent, right? You get somebody and you've done all of the comps. There's this one comp that sells for way over what the other ones are. Do you base all of your sales on that one?
No.
Or do you try to figure out why that one's the outlier?
There's typically going to be some desirability there that happens. So, I mean, you might go in between that one and then the second and the third comp and try to average it out a little bit. And I mean, you can use that, you can give it to an appraiser and say, hey, this one, this closed at this 462 price, a little bit higher. So definitely, it helps, but usually there's going to be something with more desirability. And I think a lot of times what we see, people will come in and say, oh, the house over here sold for this much more. And I think one of the biggest discrepancies is square footage. So people won't notice that that house has 500 more square feet or 1,000 more square feet because maybe they haven't been in it. It just kind of looks the same. So that could be part of the problem. So yeah, definitely have to look at comps and get stuff that's around the same square footage, beds and baths. I usually go by square footage though, because in Arizona it seems like you can, add walls pretty easily, knock down walls and all that. So, but yeah, I think that would be the biggest thing is just desirability, pool, and a lot of the landscaping and interior finishes. So.
Yeah, so sometimes when you see like a comp that's like a really crazy outlier, there's usually reasons for that. I recently had a situation where everyone based this entire sale off of this one comp, and then when you actually looked at it, I mean, the lot size was like 10,000 square feet. Ours was 7,500. Very different landscaping. I mean, this one had like a casita, beautiful pool with a waterfall and a spa, and like a trellis. I don't know, the pergola thing.
Oh yeah, those are cool.
Yeah, and so like the landscaping was so huge. I mean, and even though it was the same floor plan, technically like 3-bedroom, 2-bath, same square footage, I mean, the lot size itself was, I mean, so much different, and it backed up to the water. And so there were people that were willing to pay so much more for that house because of where it backed up and because of the landscaping, and it didn't fit in with the market. Like seriously, that appraisal actually also came in and it was like $70,000 low.
Yeah, so they probably waived the appraisal in that case. Is that
we did waive that, and so I had to do like world's best appraisal dispute.
Yeah.
But yeah, it was not fun.
So that'll create an outlier too. So if you're waiving an appraisal, and the rest of the buyers haven't waived the appraisal contingency, by the way, not the lender's appraisal, they're typically going to do an appraisal.
Yeah.
But the appraisal in the Arizona contract. So if they waive that contingency, then yeah, I mean, you can have somebody paying $100,000 over for a house, and all of a sudden that becomes the outlier, and stuff has to catch up to that. So it's
totally. And the other thing that people do is that they base the price of their home based on like what people are listing their properties for. And again, guys, it's so problematic because you have to support it with recent closings. Right. And so people in this market, I've noticed a lot of real estate agents doing is that they're pricing like the market for what they anticipate the value to be. And again, it's creating like a bunch of appraisal disparities.
Yeah. I'll look at pending listings. I think that's something you have to look at pending listings, and then in the neighborhood you look at close price to list price. I think that's kind of a good indication. So I'll look at that as well. But yeah, I mean, you just look at pending. That's fine, but then you have to see if it's going to close within the date of your appraisal. And if it doesn't close, you can't use a pending listing as a comp, unfortunately. So. Or
you have to strategically time when you get your appraisal and your close of
There you
escrow.
go.
So like
Yep.
that's and that's how you know you're working with the right realtor, guys. Is that you'll ask them like, how did you base this price on? And if they say that they used it on based on like a bunch of pending listings, you have to be like, well, when do those close? How long should we ask for this close of escrow? And if they don't have answers to that, like you should make sure that they have a plan, right? All right, and also be asking them like what their plans are when an appraisal comes in low. That's a real thing that happens all day long.
Mm-hmm.
All right. Oh, Gracie J, thank you, girl. She said, hey, Lizzie and Ryan, thanks for doing this. I just hit the like button. Guys, don't forget to hit the like button.
The like
we
button.
need this. Thank you. All right. So Lou says, oh, the Public Service Loan Forgiveness Program. Oh, thank you, Luce. I unfortunately don't know enough about that. I will investigate it though, and I'm so sorry I can't answer this on today's live. Do you know what that is?
No. Sorry.
Dang it, guys. I hate being stumped. I like to think I could win Mortgage Olympics. There'd never be a Mortgage Olympics, but if there was, I definitely want to compete. All right, so Abe says PMI on the new loan conventional can be removed after 2 years. So the general rule is yes, you have to pay it for 2 years, but it also has to be allowed through the mortgage insurance company. And so not all lenders use mortgage insurance companies that have this rule. But generally speaking, it's 2 years of payment and 25% equity in the property, and the lender will do the appraisal on that, right? So it isn't just I believe, or they go off comps. They actually send somebody out to appraise the property. All right. So let's see here. So Mario says, nope, never mind. I answered that one. Bob says, if I'm giving a gift to my sister, oh my God. So
it's nice of you, Bob.
Right. So I got the most crazy person commenting crap to me on my gift video from 2 years ago. saying that I failed to mention like all the tax
boy.
implications that come with gifting. So before I get into that, guys, let me just say I am not a tax professional. Gifting for home loans has very specific instructions, and that's all I'm really able to comment on. Now, you can Google for yourself the IRS tax, implications, the limitation on giving gift to family members, and that's all information that you would look up. But for a loan, the only thing that we care about is whether or not you have to repay the person that's gifting you the money. All right, so I digress. Back to Bob. Okay, so I'm giving a gift to my sister for a down payment. Do I have to pay taxes on the gift? It depends on the amount. Okay, guys. So Google IRS gift limitation, and it'll tell you what the amount is. There are some rules with how to get around that. So like mom can give a gift and then dad can give a separate gift, right?
Wasn't that like on Shawshank Redemption when he's on the thing and he's going to get a gift from one of the guys? Have you seen Shawshank Redemption?
I have, but honestly, I didn't look at it with a mortgage context. I've got to go back and
Probably wasn't in a mortgage, but gift from his wife or something. I don't know. But anyways, talk to Andy Dufresne on that.
So speaking of TVs and movies, does it ever make you cringe when you watch really bad real estate stuff that they show?
I don't really watch those, to be honest with you. I'm not. I don't know. I mean, I watch Ryan Serrant a little bit on YouTube, but I don't watch Selling Sunset or. Do you watch that stuff?
I don't, but I do watch Vanderpump Rules, guys. And okay, so for the people that are watching this right now, I would love your opinion on this. It would mean a lot to me if you chimed in. But this entire season had a bunch of basically the Toms were trying to refinance their home loan so that they could invest in this bar. And what was crazy about it was how little their significant others understood a real estate investment and equity. And it was terrible because it was one of the Toms couldn't qualify and he just couldn't figure out why. And then one of the girls was well, he's only refinanced to take out his part of the equity. And it's no, it's a home loan that you're both on. And equity is dependent on the value of the home. If the market goes down, is he gonna owe you money? It's so crazy, and they sounded so nuts. And so basically what I want to do is do a side by side on all the dumb things they said about real estate and do a video commentary on that. There you go.
It's a great idea.
Would you watch that? I mean, I felt like I needed to just
that would be good just in general in real estate too. Just watch these because I mean I don't I just see kind of the outtakes and maybe read some stuff on, the gossip channels occasionally. But, that would be nice. You put that side by side with, what actually...
But it was, terrible. And, Lisa Vanderpump's I don't think you understand how a mortgage works. And they're yeah, I totally get it. So, let me know.
Yeah.
Okay. Oh, my God, you guys. Ernesto Ibarra was a client of mine. One of my all-time favorite clients ever. Oh my goodness. Thank you so much for the support on here. I really appreciate you.
Javier's got a really important question there.
And then Gabby D says she's late. She has to watch the recording later. Well, I'm glad that you made it. Still definitely give us a thumbs up. Shadow Llama would watch but would get... Oh, but would it get copied? You know what? No, there's lots of reaction videos on YouTube. I did ask my editor about this. So I think you can use clips. Lots of people use clips, but I am going to look into that. Yeah. Thank you for the FYI. Now, to answer Javier's question, just so you know, you actually can use revenue like OnlyFans and revenue from places like YouTube, so long as you can show a consistent and stable history of receiving them, typically 2 years. So yes, it is. I mean.
Has he been doing that 2 years?
Javier? Yeah. Javier's been on YouTube. Yeah.
Well, OnlyFans.
Oh,
I think he's been on OnlyFans for 2 years.
I mean, he hasn't. He doesn't have an OnlyFans, but he's trying to mess me up. But I have had clients that are on OnlyFans that have used that income.
Have you really?
I have.
Wow.
I am if you can qualify, I will help you.
Yeah.
Actually, honestly, even if you can't qualify, I will still help you. That is what it is. But yes, I mean, what would I, yes. If it's stable and consistent income, guys, you can use it for home loan. You can use it. You have to break it up. See? Javier knows.
Gotcha.
Awesome, guys. All right, guys, so we just got to the hour. I was 12 minutes late, so we can go a little bit longer if you guys have some questions. But any final thoughts from you? Like market, being on this live, these amazing people that watch us.
Yeah, I look really tan. I'm like looking at myself, and I don't know if I'm just like blushing and
You
red
are,
or like,
you
or if
are
I'm just
less tan in person.
I don't know what's going on. Maybe the lighting is what's going on in here. But anyways, usually I'm not this red. So, but yeah, no, this has been great. Lizy is just a wealth of information. I mean, she's definitely,
Do I live up to the hype?
Yeah, you do. Yeah, it's been. I just started watching your lives. I mean, it's just a ton of information every time I watch them. So thank you for having me on. Yeah, it was very, very informative, even for myself. So really cool. And yeah, in terms of inventory, I mean, we are at all-time lows. So just so you guys know, under 5,000 here in the Phoenix area. I haven't seen it hit this level, so it's usually picks up right now. So just to let you know, if you're wondering if it's a good time to buy, I think it still is. I don't think you've missed the boat. So get in and purchase a home. So
I love that. Yeah, guys, I mean, I have kind of gotten sick of tracking inventory.
Yeah, it's kind of
just because like when we had 7,500 homes, that was like historically low, and then we just kind of been teeter-tottering, in those like, low thousands. But I will say this, there's still a lot of homes for people that are available. You're one person in 5,000 looking. You just have to make sure that you're aggressive, consistent, and that like you understand that this might also be your starter investment versus like your dream home, and I do think that like help curb like expectations matters a lot.
Yeah.
But yeah, generally speaking, this is like when things start getting really busy in real estate. So hang in there. Mm-hmm. We should be seeing lots of more inventory. So let's see here. We got, hello, Lizy. Would like to schedule an appointment with you if possible. Going to be in Arizona, February 14th. Oh yeah, that's a Monday. Definitely email the team. Can you put that in can you type that? Like, can I type that? Am I logged in? Okay, sorry. No, it says I have to sign in. Can you put my website address? Yes, would love to get you scheduled for you to come to the live. Or not live, but meet me in live. Yeah, have more an appointment. Jesus. Okay, Kyle said, when you said 6 p.m. Mountain Standard Time, is that Mexican Standard Time? So yeah, you know what, guys? So for those of you who don't know, I'm also Hispanic. I'm like world's whitest Mexican, but I'm very proud of my heritage. So yes, it's probably Nogales time. Too funny. Can you discuss home improvement loans with conventional loans? So yes, I absolutely can. So whenever you're going to do, so it's not technically called a construction loan. They're called renovation loans. And so typically what you're doing is you are financing in the cost to renovate your property or improve your property. There are some limitations to them in terms of like what types of improvements you can make or adjustments you can make to the house. Typically you can finance up to 110% of the after improved value. But they're really, really great loans. Now, they're great loans for buying like a fixer-upper property or for maybe your starter home or for you to get creative. Where I see them be more difficult is the closing time on them is typically like 60 to 90 days. And it does require you to have to find a contractor who's willing to be paid like in increments after the fact. And so not every contractor is willing to do them. And typically the ones that can are not the most affordable. So you just want to keep those things in mind. They usually come at a higher interest rate, again, because you are financing in improvements. But it is another way for you guys to get creative. And I probably would recommend doing them more on a refinance than a purchase, right?
Yeah.
Do you think that those loans are competitive in the marketplace?
I mean, I would definitely do it on a refinance. Yeah, for sure.
Yeah, you just typed in my web address.
Oh, okay.
It says TeamHoeffer because that's Zeke right now, but we weren't signed in, and I just like panicked. Oh my God, too funny. All right, so let's get one last question in here. So it says, is it true that closing costs for new construction homes are a lot higher? I'm looking at new construction and looking at going through their lender. They don't provide any closing cost assistance?
Yeah. So I would, if you're going with a new construction lender, I would definitely get an outside lender to compete with because, yeah, in a lot of cases they're going to be a little bit higher and they'll try to get you on some fees, possibly. In some cases they might not. So I think it's always, if they're making you pre-approved with their lender, definitely get an outside lender and compare those rates and see what you could do in terms of fees.
Yeah, so I've noticed that in this marketplace, they're not really providing a ton of incentives for closing costs, and they're also not providing a ton of incentives for home improvement. And so the only advantage is that, there really isn't an advantage to going with their builder's lender at the moment. A lot of them will just do it because most people, guys, 60% of the population just follows the next step for whoever is telling him what the next step is. But if you are somebody that does their homework, yes, in this year I have seen that home builders financing in terms of fees and interest is amongst the highest tier when you're looking at ranges. So I do think in this market it is smart to compare. Even if they are offering you closing cost assistance, I recently looked at a builder's fee sheet and there was $14,000 of lending expenses with a $5,000 seller credit. And so you're still paying what is that, $9,000 worth of closing costs, right? And so you might be paying $8,000 with another lender. And so I definitely would do the homework. But in cases where they are offering those seller contributions or the incentives towards improvements to the house, sometimes they're really hard for us to beat, right? But if you did ask me, I would tell you what the better option is. I've told people to go with the builder before.
Yeah, definitely.
And most of them will require you to get your credit pulled with them and at least get pre-qualified.
Yeah.
Do you ever find that they let you buy a new build without that?
No, you can get with Toll Brothers. They have a pre-application worksheet, so they'll look up a little bit, but they won't do a hard pull until you're actually you're up in line basically. So you can do pre-application worksheets, but yeah.
Cool.
Just gotta wait till your card's taken and you're good to go. So.
Brian, it was super awesome to have you on this live.
Well, thank you for having me, Lizzie. I appreciate it.
All right, guys, if you haven't yet, go ahead, hit the like button on this live. It means a lot to me. And go ahead and check out this week's video. It's all about budgeting and actually how to budget for qualifying for a home. There's a lot of information in there that I think is applicable to just regular life and the buying process. Would love for you guys to view and give that a thumbs up if you have time. So I appreciate you guys, and tune in next week. We'll be doing another great live to answer your questions.
Good night.